Okay, we're broadcasting now.
Okay. And do you want to make some introductory remarks?
I don't really have much to say.
Okay.
Yeah.
Well, hello everybody, and welcome to the second day of the trainings. We'll be starting momentarily. We're just giving others a chance to log in. Okay, thank you. Okay, well, it seems like most people have arrived. So welcome back. Welcome to the second day of the trainings. And I hope you had a nice day off yesterday. On day two, we're going to continue our session on operational boundaries and conclude the presentation, follow that with a short exercise. And then we'll do two complete sessions, one on tracking emissions over time and recalculating base year inventories to ensure that companies can consistently and meaningfully track performance against a target. And the second lesson will be on calculating emissions. Both of those two lessons will have their own exercise as well. Again, we will be taking a break, but the exact timing of that break will depend on to what extent we're on schedule. Okay. Before we continue with the remainder of lesson 4 on operational boundaries, I wanted to pick up on some questions that we didn't have time to address and look at from day 1. So I've included them on this Word document, and let me go through them. So one question is purchased carbon dioxide that's used throughout operation and then released, should that carbon dioxide be included in scope 1 or scope 3? And the answer is scope 3, because the reporter who emits the CO2 and captures it would report those emissions in scope 1. So even though those emissions have been captured, they're still reported in scope 1 by the organization that emits and captures those emissions.
Stephen, I'm not sure if people can see your screen.
Thank you for letting me know. Thank you for letting me know. So hopefully you can now see my screen.
Yes, thanks.
Okay, thank you. Thank you. Sorry for that all. But here are the questions. So one question was around purchased carbon dioxide. The second question here relates to the emissions from land clearing activities. And let's talk about land use change more generally here. the biogenic CO2 emissions from land use change are always reported outside of the scopes. So if you remember, yesterday we discussed briefly the biogenic carbon cycle and the fact that emissions from biomass are subsequently reabsorbed by growing vegetation. And because of that, under the corporate standard, we assume that biogenic carbon emissions are carbon neutral and that they can be reported outside of the scopes. Okay. That requirement pertains to the biogenic carbon emissions from all kinds of biomass, including biofuels, but also vegetation on land that has been cleared or land that has undergone land use change. Okay. So to recap, the CO2 emissions from land clearance are reported outside the scopes, but all other emissions will be reported within the scopes. And that includes, say, the emissions from the use of machines used to clear the land, and also the methane and nitrous oxide emissions from the biomass. Okay. A third question here asked, what is the vision when it comes to accounting for all of the world's emissions in an ideal state, if any? Ideally, companies would be reporting their Scope 1 and 2 emissions. And in fact, every company would be reporting their Scope 1 and 2 emissions such that companies don't need to account for their Scope 3 emissions. And in that ideal state, every company would be setting ambitious targets for their Scope 1 and 2 emissions that are in line with what science tells us is necessary to reduce global warming to below 2 degrees above pre-industrial levels. However, that's not the case. Most companies don't report their Scope 1 and 2 emissions, and many companies have not set ambitious Scope 1 and 2 targets. So given that, it's still important to report on Scope 3 emissions. Of course, Scope 3 emissions are optional in the corporate standard, but the Scope 3 standard provides extensive guidance on how companies can develop comprehensive Scope 3 inventories. One related issue is why companies should still account for Scope 1 and 2 emissions under this ideal state. And the answer is doing so provides them with some flexibility in meeting their energy needs so that they can shift from on-site energy consumption to purchase grid electricity and vice versa. The last question here concerns contracted vehicles. And if I understand the question correctly, the emissions from contracted vehicles will be reported under Scope 3. And in a sense, this is a nice segue into our lesson later on today, on lesson 5, when we'll be discussing how to report the emissions from outsourced and insourced activities and the implications of those changes for base year inventories. So in a sense, we'll be picking up on this topic later on today, but for the time being, the emissions from contracted sources, contracted vehicles, are reported under Scope 3. Okay. Let me load the presentation for lesson 4. And on Tuesday, we didn't get to the topic of leased assets, and I want to spend a few minutes on this because it's important to understand how to account for the emissions from leased assets. And doing so requires understanding the interplay between two factors, between the type of leased asset and the type of organizational boundary approach. And just looking at types of leased assets, first of all, the first type of lease is a capital or a finance lease, and this type of lease enables the lessee to operate an asset and also gives the lessee all of the risks and rewards of owning that asset. In a capital lease, the lessee has use of the asset over most of its useful life, and assets leased under a capital or a financial lease are considered wholly owned assets in financial accounting and are recorded as such on the balance sheet. Okay. The second type of lease is an operating lease, and this type of lease enables the lessee to operate an asset, such as a building or a vehicle, but doesn't give the lessee any of the risks or rewards of owning that asset. In an operating asset, the lessee only has use of the asset for some of its useful life. Any lease that isn't a capital or a finance lease is an operating lease. There are various criteria that define when a lease is a capital lease versus an operating lease. Some of these criteria are if the lease contract transfers ownership of the asset at the end of the lease life, or if the contract contains a bargain purchase option, or if the lease term covers the majority, 3/4 or more of the asset's life, or also if the present value of the lease payments is 90% or more of the fair value of the asset. So those are the various criteria that go into defining when a lease has been leased under a capital leasing arrangement. And if it's not a capital lease, according to those criteria, then it's an operating lease. So understanding which type of lease is important. And whether leased assets are scope 1 or scope 3 for a company depends on both the approach chosen to set organizational boundaries and on the type of leasing arrangement. And this table shows this interaction. Let's take the lessee's perspective first of all. Under the operational control approach, the lessee is considered to have control or ownership of the lease and therefore accounts for the asset's emissions as scope 1 or 2, regardless of the type of lease. In contrast, under the financial control or the equity share approaches, the lessee is considered to have control or ownership only if the asset is leased under a capital lease or finance lease, and would account for these emissions as scope 1 or 2 in these circumstances. Under an operating lease, the lessee is not considered to have control or ownership and would account for the emissions as scope 3. Okay, so that's the accounting from the lessee's perspective. The accounting is reversed for the lessor's perspective, as shown at the bottom of this slide. So in other words, what's scope 1 or 2 for the lessee is scope 3 for the vice versa, is scope 3 for the lessor, and what's scope 1 and 2 for the lessor is scope 3 for the lessee. This is one of the final slides in this lesson, and it discusses double counting. I've included this slide to emphasize an important function of the scopes, and that's to help reduce the risk of double counting. which occurs when different companies claim ownership of the same emissions or reductions. And scopes are important because they allow companies to account for emissions along their value chains while preventing double counting. The same unit of emissions should never be reported under the same scope by more than one company. There is one exception to that general rule, though, and that concerns Scope 3. I touched on this point earlier, but it's important to emphasize. A company's Scope 3 emissions could legitimately be another company's Scope 3 emissions. So let's take an example to illustrate that. Let's take, say, the CO2 emissions from fertilizer production. These emissions are Scope 1 for the farmer or the organization that produces the fertilizer. They're Scope 3 for the farmer that applies the fertilizer to his or her soil. But they're also Scope 3 for the supermarket that sells the farmer's crops, or the consumer even that eats the produce. Okay? So Scope 3 accounting inevitably involves double counting Scope 3. What's Scope 3 for one organization will invariably be Scope 3 for another company, and perhaps multiple companies. So in summary, we covered a number of topics in Lesson 4. We've learned that operational boundaries determine which emissions are included in an inventory and whether they're classified as Scope 1, 2, or 3. Both Scope 1 and 2 emissions are mandatory, while Scope 3 emissions are optional under the corporate standard. And the selected consolidation approach should be applied to leased assets and also outsourced activities or franchises to help understand which scopes these activities fall under. For further reading on the topic of operational boundaries, you can turn to a number of sources. The primary reference should be Chapter 4 of the Corporate Standard and its appendices A and F. Appendix F is on leases and is available online from the GHG Protocol website, and Appendix A is in the print edition of the Corporate Standard. Another important reference for Scope 2 accounting and the market-based approach in particular is the Scope 2 guidance. And again, you will all receive, following this training, a link to a recording of a training on the Scope 2 guidance. 2 other publications might be useful, including the Hot Climate Cool Commerce publication I mentioned on day 1, and the ISO standard 14064 Part 1. Okay, let me pause for a second and see if there are any questions. We have a couple of questions relating to leased assets. One question asks, under operational control approach, would the company account for electricity usage in Scope 2 for leased office space? The important point here is that to understand whether the emissions from a leased asset, from the leased office space, fall under Scope 1 or 2 or Scope 3 depends on 2 things: the type of lease and the organizational boundary approach used. Okay, so you'd have to answer that question, you'd have to identify whether you're using operational control or equity share and financial control. And then you'd go back to this slide to understand under what scope the emissions would fall. Okay. Cindy asks how capital leases are different from ownership. That's a good question. And in some sense, they're almost not. Capital leases are essentially a form of financing. The company can enjoy the long-term use of an asset under a leasing arrangement even when it doesn't own that asset. Okay, but nonetheless, under a capital lease, a company can, for example, have that leased asset for 75% or more of the asset's life, for example. So companies would enjoy the asset for a long term over a substantial proportion of the asset's life, but technically they don't own the asset. We have another question around scope 2. Are scope 2 emissions double counted? For example, if I hire electricity and include this as scope 2, wouldn't the company I hired already have included this in their scope 1? So yes, so if, let's take an example, a company that sources power from a local generator, okay? The emissions from the combustion of fuel to support electricity generation, those emissions would be reported under scope 1 by the electricity generator. And they're reported under the scope 2 of the customers of that generator, okay? So the emissions are reported by different organizations, but they're reported in different parts of their inventories under the different scopes. So in that sense, double counting isn't a problem. If we were to sum up all of the scope 1 emissions of companies worldwide, then assuming they all use the same organizational boundary approach, then all of those scope 1 emissions would amount to or equal the total emissions emitted to the atmosphere globally. Okay, so in that sense, there's no double counting between the scopes. And Antonio, to take your question, which asks, if we use purchased carbon dioxide for wastewater pH adjustment, would that be accounted for as an emission? And yes, technically the answer is yes, it would, and it would fall under scope 3 again, although it seems like this would be a very small source, at least for most companies. Okay. Let's take the exercise for operational boundaries. I'll give you a moment to load it. Okay. This exercise contains 5 questions. We'll do question 1, and then we'll do questions 2 through 5. Let's look at question 1. Here, Greener Co. accounts for its scope 1, 2, and 3 emissions on an annual basis. It undergoes changes in its business operations, as described in the following table. And we're asked to indicate whether each change in Greener Co.'s operations would cause its scope 1, 2, and 3 emissions to increase, decrease, or undergo no change at all. And for scope 2 changes here, let's assume that we're using a location-based method with no sales of certificates such as RECs, or no contracts to purchase differentiated low carbon electricity products. Okay, so this is a purely location-based accounting scope 2 exercise. So what I'd like you to do is just think about these cases for a minute or two and think through their impact on scope 1, scope 2, and scope 3 emissions. Then I'll come back with my interpretation and we can have a discussion as needed. I want to make sure that people can see the exercise on the screen. If you can you please let me know? Just type a quick yes or no into the chat box. Thank you. Okay, good. Valeria, I see you're having problems downloading the material. We'll send round a link to the folder again. Okay, let's run through the cases here. The first case, a company installs an on-site natural gas-fired power generation plant that replaces coal-based electricity from the grid. And we can assume that all gas-fired power is consumed by the reporting company. And I'm also going to assume that the plant was constructed by a third party. So in terms of the impacts on the scopes, Scope 1 emissions would increase because the plant is on site and owned and controlled by the reporting company. Scope 2 emissions would decrease because the company is consuming less grid electricity. And as we saw on day one, the impact of this action on the company's Scope 3 emissions will really depend on two considerations. The first concerns the Scope 3 emissions that occur upstream of energy production. For instance, the emissions related to the mining of coal and the production of natural gas. And we also have to consider the Scope 3 emissions associated with the construction of the plant. For example, the use of contractors and the emissions from the extraction and processing of the various building materials. So if the upstream emissions from coal use are larger than the Scope 3 emissions from plant construction and natural gas production, then overall Scope 3 emissions will fall as a result of the new natural gas plant. And conversely, if the upstream emissions from coal use are smaller than the Scope 3 emissions from plant construction and natural gas production, then overall Scope 3 emissions will increase. Okay, so that's the first consideration, which is you have to think about the relative magnitude of the upstream Scope 3 emissions associated with either option. A second consideration concerns what Scope 3 categories the company is reporting in the first place. If the company isn't reporting any of the Scope 3 sources I just mentioned, then there'd be no recorded impact on Scope 3 whatsoever. So the basic point is we have to keep in mind both the actual and recorded impacts, and I think these cases are helpful in reinforcing the point that it's not really feasible or recommended to compare the Scope 3 inventories of different companies. Companies will have different structures, companies will be reporting different Scope 3 categories, and those facts don't support Scope 3 emissions comparisons across companies. Turning to the second case, here a company substitutes on-site coal-fired power plant with an on-site wind power plant to generate electricity. And again, I'm going to assume that the plant was constructed by a third party. Here, Scope 1 emissions would decrease because there's less stationary combustion at Scope 1 sources. There is no impact on Scope 2, and as we saw in the first case, the impact on Scope 3 will depend on which Scope 3 categories the company is reporting and on the relative size of the Scope 3 emissions from construction of the new power plant and the acquisition of coal. So if the supply chain emissions associated with coal were greater than the Scope 3 emissions from plant construction, then Scope 3 emissions would fall and vice versa. Okay. Turning to the third case, here the company installs an on-site solar power generation plant to replace the need to purchase electricity. Here there's no impact on Scope 1, assuming there are no emissions associated with operating the solar plant. But Scope 2 emissions will fall because less grid electricity is being consumed. And for Scope 3, again, we need to look at the Scope 3 emissions associated with grid electricity, such as the mining and processing of stationary combustion fuels, versus the Scope 3 emissions associated with installing and operating the solar plant. Okay. For case 4, here a company increases the efficiency of boilers used in on-site manufacturing processes. And I'm going to assume that the boilers use fossil fuels. Here we're looking at a Scope 1 source, so the Scope 1 emissions would fall, everything else being equal, assuming there's no increase in activity. There would be no impact on Scope 2. And in terms of Scope 3, assuming there's no other change in the manufacturing process, such as in the volume of inputs or outputs, then Scope 3 emissions will fall, simply because less fuel is being consumed. And finally, in the last case, the company outsources product manufacturing to a third party. Here the emissions decrease, assuming manufacturing processes caused on-site emissions. And likewise, Scope 2 emissions will fall, that's assuming that manufacturing process used electricity. And in terms of Scope 3 emissions will increase since the outsourced process is being brought from Scope 1 and 2 to Scope 3. Okay. So hopefully that was clear. If you have any questions, please feel free to ping me with them. For the time being, what I'd like you to do is to tackle the remaining questions in this exercise, questions 2 through 5, okay? So So I'll give you a couple of minutes to do that again, and then I'll come back with my own answers. So I see a couple of questions relating to the case of the boiler. Boilers used in on-site manufacturing processes. That was case number 4 here. Let me go over the answer again. Here I assume that the boiler consumed fossil fuels and the company is increasing the efficiency of that boiler, meaning that it consumes less fuel for a given amount of energy output. Okay. So assuming that the company doesn't use those energy savings and take advantage of those energy savings to increase output, if we assume that everything else is held constant, then scope 1 emissions will fall because the company is using less fuel. Okay. Just because it needs to use less fuel to generate the same amount of energy output. There's no impact on scope 2 because we're looking at a fossil fuel combustion source. And in terms of scope 3 emissions will decline because less fuel is being consumed, and there are then fewer upstream emissions related to the extraction and the processing and transportation of fuels used by the boiler. Okay, and okay, I hope I'm not interrupting people as they're concentrating on the remaining questions, but if you had a question around the first case in the question, then I'll tackle that question again now. Otherwise, you can continue with the remaining questions. For that first case, the company installed an on-site natural gas-fired power generation plant that replaced coal-based electricity from the grid. This action will increase scope 1 emissions because the gas-fired plant is on site. So we're moving an emission source from an indirect category, scope 2, to a direct category, scope 1. Scope 1 emissions will increase. The scope 2 emissions will decrease because the company is consuming less grid electricity. And the impact on scope 3 depends on what scope 3 categories the company is reporting in the first place, but it's also a function, I think more importantly, it's a function of the relative magnitude of the upstream scope 3 emissions associated with either option. Okay. So when you're looking at the on-site natural gas-fired power generation plant, you want to consider the scope 3 emissions associated with the construction of that plant and the emissions from the extraction and processing of the building materials and the emissions associated with the extraction, processing, and transportation of natural gas consumed by the plant. And similarly, when you're looking at the coal-based electricity grid generator, you want to consider the upstream Scope 3 emissions from the extraction, processing, and transportation of the coal. Okay. So the impact on Scope 3 will really depend on the relative size of these upstream Scope 3 emissions. Okay, so hopefully you had a chance then to complete the questions 2 through 5. I'll just make sure that you can see the answers here. Okay. So turn to question 2. Here the company produces cement. In year 1, the company had its own vehicle fleet, and in year 2, the company sold that fleet and instead contracted a transportation company. So the company's direct Scope 1 emissions will decrease because the emissions are no longer coming from sources, vehicles that are owned and controlled by the reporting company, and because the emitting activity was outsourced, Scope 3 emissions will increase. Scope 2 emissions, we assume, are unaffected because or unaffected unless the company uses electric vehicles. For question 3, here the firm's employees rented cars to travel to meet clients. In year 2, the company stopped renting cars and instead purchased its own vehicle fleet. And the company in year 2, or the employees, travel at the same frequency, so there's no change in activity data. Here, the direct emissions will increase in the second year because this time the company is insourcing the emitting activity. It's purchasing and it now owns its own vehicle fleet. Again, assuming that the company did not purchase electric vehicles, Scope 2 emissions would be unaffected. And Scope 3 emissions will decrease in year 2 because the emitting activity has been insourced. Okay. Now, one point here that we'll pick up later on is that if the insourced activity is important in terms of its GHG emissions, then that insourcing might trigger a recalculation of the base year inventory. And the same is true for outsourcing. So that is an important point to keep in mind, and is something that we'll turn to shortly. Let's look at the fourth question here. This concerns leasing assets and understanding under which scope the leased assets emissions would fall. Here, it's important to bear in mind both the organizational boundary approach used and the type of leased assets. So if the financial control approach is used, then company R would account for the emissions because it's using an operational lease. If the operational control approach is used, company Q would account for it. And if the equity share approach is used, company R would account for the emissions. Let's think about question 5. Okay, this concerned a multinational company with offices in the US, Europe, and one in some other unnamed country in which no product or supplier specific information is available. Okay, so as we can see from the question stem, differentiated electricity products are available in the US and European, Norway markets, but not in this unnamed third country. Thinking back to lesson 4 on day 1, recall that companies have to report 2 Scope 2 totals whenever they have operations in any country that offers differentiated electricity products. And that's true regardless of whether or not the company actually purchased these products. So company Y in this case would have to report 2 Scope 2 totals, one corresponding to the location-based approach and the other corresponding to the market-based approach. What data should company Y use to calculate the market-based method total for the country with no product or supplier-specific information? Well, in this case, the company has 2 options. It could use something called residual grid average factors, if they are available, or it could use standard grid average emission factors. Residual mix factors are essentially grid average emission factors with the emissions profile of purchased differentiated electricity products subtracted from them. Okay, and that subtraction is done to avoid double counting the emissions benefits of those purchased electricity products. Okay, so to come up with a residual mix emission factor, you take grid average emission factor and you subtract the emissions profiles of those differentiated electricity products that have been purchased and claimed by some other organizations. And you do that to prevent the double counting of those emissions benefits. Okay. Those kinds of residual mix emission factors aren't available for all countries. They're available for the US and the EU, but not for many other countries. And in cases where those residual mix emission factors are not available, then a company can simply default to the standard grid average emission factors to calculate the emissions under the market-based approach. Okay. So just to recap, when a company, in this case, the company has to report emissions under the market-based total. And to do so for the country that offers no differentiated products, it would use the grid average emission factor. And so for that country alone, the emissions reported under the market-based total would be the same as those reported under the location-based total. Okay. And finally, in year 2, does the market-based method scope 2 figure increase or decrease? The answer is it decreases because the US emissions stay the same at 0, while the emissions reported by the Norwegian office decrease. And the no product country operations will remain unchanged. Okay, so hopefully that was clear. And just to respond to a question that came in, we covered location and market-based approaches earlier in lesson 4 on day 1 on Tuesday. But again, we'll be sending out all of the material, including answers to these exercises, at the end of the day. Okay, so our next lesson will be on tracking emissions over time. Before we start that lesson, let me take a few more questions I see in the chat box. Valeria, I see a couple of questions from you on the transport tool. I'm going to postpone answering those until we come to lesson 6 on calculating emissions. Mandy asks, what if we lease a warehouse space that is shared with other businesses? How do we report that electricity? Good question. And the standard approach, if the company's use of that warehouse is not separately metered, then the approach would be to divide or to account for a share of the warehouse's total electricity that's based on the amount of floor area used by the reporting company. So you'd account for the emissions on the basis of the proportion of floor area used by the reporting company. David, I see your question, which is, what if a company leases cars for their employees? Would the fuel burned be scope 1 or scope 3? And again, the answer here is it depends. It depends on the organizational boundary approach and the type of leased assets. So you'd have to refer to that earlier table I showed earlier on, which shows this interaction, to understand how the emissions are accounted for by the different parties, by the lessor and the lessee. Okay, so whenever you confront a situation, whenever you have to account for the emissions from a leased asset, you do have to bear in mind those two factors and understand how they interact. To respond to another question, I will come back to the discussion of market-based and location-based emissions. I won't do that now, but I will do that in lesson 6, okay, where I'll discuss the types of emission factors used for those two approaches. And I think that would be a useful place to pick up that discussion and reiterate again the distinction between the market-based and location-based approaches. So if you can just bear with me a minute or two, and we'll come back to that discussion later on. Okay. Let's turn to the next lesson, which is tracking emissions over time. So I said on Tuesday that there are 3 main accounting steps in designing an inventory. Those are setting organizational boundaries, setting operational boundaries, and then setting a base year inventory and recalculating that inventory over time to ensure it remains useful as a basis for tracking performance. So we'll come to that last topic now. In this lesson, we'll cover a number of items, including how to assess a company's emissions trends, how to choose a base year, why you may need to recalculate base year emissions, as many companies often have to do, and how to go about that recalculation exercise. And yes, we'll have a short break soon. Let me just finish this presentation and then we'll break for have that break. Okay. Okay. So in terms of the base year itself, what is a base year? The base period or the base year is the period in history against which an organization's emissions are tracked over time. And the corporate standard requires companies to set base years as they're so important for inventory design for a number of reasons. One is that they help companies track progress towards reduction targets. They help companies put the effects of changes in inventory practices into context. And we'll cover both of those applications in this lesson. In terms of choosing a base year, we would recommend that a company select as the base year the earliest year for which verifiable data are available for the required scopes, that is for scopes 1 and 2. So in this example, a company only has scope 2 data for years 2005 and 2006. And so would not select either of these years as the base year. Scope 1 and 2 data are instead available for 2007, and so this could be the base year for that company. And note that the company could select 2008 as well, particularly if it wanted to track Scope 3 emissions beyond 2008. In addition to requiring that companies set base years, the corporate standard also requires companies to explain why that particular year was chosen. And a fundamental consideration in selecting a base year is that it has to be representative of a company's emissions profile. Otherwise, if the chosen base year were not representative, then it wouldn't allow for meaningful comparisons of performance over time and would effectively be useless. So if emissions do fluctuate dramatically over time, the corporate standard also recommends that companies consider averaging emissions over a series of consecutive years to derive an average base year profile. Okay? And the important point here is that the years that are averaged over should be consecutive. An averaged base year shouldn't be based on a set of non-consecutive years. Jesse, to answer your question, yes, the company could not select 2005 and 2006 in this case because it's missing Scope 1 emissions. Scope 1 and 2 emissions are required in inventories under the corporate standard, meaning that 2005 and 2006 could not be selected. I think an important point here is that if a company has a long history in reporting emissions, then it may make sense to use a more recent base year instead of the one for which, so the first year for which verifiable data emissions are available. So if a company had verifiable emissions data for 2005 for both scopes, as well as 2015, for example, that would clearly make sense to use 2015 as its base year. Nicholas asks a question regarding the requirements of the Science-Based Targets Initiative. And the Science-Based Targets Initiative recommends that companies use the latest year data as the base year inventory. And that's true. And one reason for that is because the Science-Based Target Initiative has developed a whole set of criteria and recommendations around what constitutes an ambitious, forward-looking target. And in order for the initiative to validate the ambition and forward-looking element of that target, it's easier for companies to have and to submit a more recent base year inventory. Jesse asks, what if a company's Scope 1 inventory is incomplete? Should it still report that inventory, and perhaps should it still use that inventory as its base year inventory? And I think the answer is yes. I don't see any problems with that. I think it's important to emphasize that greenhouse gas inventories are a work in process. They're continually being updated and refined as the company develops new emission factors and identifies more accurate calculation methods. So it's fine, I think, to use an incomplete scope inventory and to report that inventory and use it as its base year inventory. But going forward, it should make sure to refine those estimates over time and to ensure that the inventory is complete. Once a base year has been selected and an inventory has been developed for that base year, it's important to understand when that inventory needs to be recalculated to ensure consistent inventory data and consistent boundaries over time, and ensure that the base period remains useful as a basis for tracking performance. The corporate standard requires companies to do a number of things in this regard. It requires companies to retroactively recalculate base year emissions to reflect company changes that could compromise consistency and relevance of emissions data over time. It requires companies to develop a base year emissions recalculation policy and to apply that policy in a consistent manner over time. And essentially, this policy would state when changes are significant enough to trigger recalculations, and I'll come back to that point in just a second. Finally, companies also need to report in their inventories when and why they've recalculated their base period data. So what factors cause recalculation? What factors trigger recalculation of the base year inventory? Well, in the corporate standard, the main reasons base years have to be recalculated are when significant changes have occurred in the structure of an organization, significant changes occur in calculation methodology, such as the discovery of improved emission factors or improved activity data, and the discovery of significant errors in inventory processes, or the discovery of errors, small errors that are collectively significant. And conceptually, changes in organizational structures can be more difficult to understand than changes in calculation methods or the discovery of errors. And so what I want to do is to spend a few slides explaining how organizational changes affect base year inventories. But before I do that, what I want to do first of all is explain what the term significance means. So as you can see, significance is a term that's common to all three of these requirements, but what does it mean exactly? What are the practical implications of this term? To determine whether a change is significant, it's evaluated against a significance threshold. Okay, so to take an example, a threshold level of significance might be 5%. Okay, in that case, if a change in inventory boundaries or methodology results in a change in the base year inventory that's equal to or more than 5% of the total emissions reported in the inventory, then that change is considered significant. The corporate standard doesn't actually require or recommend a specific significance threshold. However, many GHG reporting programs would do so. So to take an example, the Brazil program, the Brazil GHG Protocol program, has a significance threshold of 5%. And a 5% significance threshold is relatively common. So again, the corporate standard doesn't actually require or recommend a specific threshold. Instead, what we find is that the corporate standard simply requires each company to define its own threshold and then apply that threshold consistently over time. So let's get back to the issue of recalculating base year inventories for changes in organizational structures. And here, structural change is defined as the transfer of ownership or control of emitting activities from one company to another. Different types of structural changes exist. So one is the purchase or divestment of operations that existed in the base year. Another is outsourcing or insourcing of emitting activities. We'll have some examples of those in just a minute. Both of those structural changes will trigger base year recalculations, provided that the change meets the significance threshold. And the one exception to be mindful of here relates to outsourcing or insourcing. If the outsourced or insourced activities were previously included in a different scope within an inventory, then there's no need to recalculate the inventory. Okay, so to take an example, if an activity were previously reported in scope 3 but was subsequently insourced and moved to scopes 1 or 2, then there'd be no need to recalculate the base year inventory because the emissions were already reported by the company. And it would make sense to do a recalculation there. Another general point is that while a single structural change might not have a significant impact on the base year inventory, the cumulative impact of multiple changes may well be significant. So that's something that's important to bear in mind when assessing the need to recalculate base year inventories. It's really necessary to consider the cumulative impact of multiple changes. Okay, so let's take some examples. Here is a basic example of recalculating base year inventories for structural change. In the first general case, if company A acquires company B, company A would include the emissions of company B in both its current inventory and its base year inventory. And this is, of course, assuming that company B existed in company A's base year and that the significance threshold was met. Conversely, if a company divests company B, then it should exclude the emissions of company B from both its current inventory and its base year inventory. And again, that's assuming that company B existed during company A's base year and that the significance threshold was met. Just to make clear, I thought it'd be useful to list on a single slide the various instances when organizational boundaries never trigger recalculations of the base year inventory. We've gone through two of these already. We've seen that recalculations are not necessary when changes occur that involve facilities that didn't exist in the base year inventory, and when we're dealing with outsourcing or insourcing of activities that were previously reported under a different scope. But there is a third type of change for which recalculations should not be conducted, and that's when a company has only experienced organic growth or organic decline, as opposed to some kind of structural change. Okay. If I open up the corporate standard on page 39, the corporate standard defines what it means by organic growth and organic decline. I'll just read it out to you. Organic growth decline refers to increases or decreases in production output, changes in product mix, and closures and openings of operating units that are owned or controlled by the reporting company. So again, organic growth or decline refers to increases or decreases in production output, changes in product mix, and closures and openings of operating units that are owned or controlled by the reporting company. Okay, so to take an example, if a company simply grew by adding on more manufacturing company, perhaps it built a new plant, that growth wouldn't constitute a structural change, and it should never trigger recalculation of the base year inventory. So let's just have a couple of examples to illustrate how base year calculations work in practice. And I find it's often easier to visualize recalculations this way. So this example shows how recalculations would work if a company acquired a new operating unit. here the company emitted 50 tons in its base year in year 1, then experienced an increase in production in year 2 when it emitted 60 tons. That was an increase in production and so would not trigger recalculation of the base year inventory. And in year 3, the company again emitted 60 tons, but it also acquired a unit at the beginning of that year that emitted an additional 20 tons. So when developing the inventory for the third year, the company just adds on the 20 tons of emissions from the acquired unit to its 60 tons, for a total of 80 tons. But for its base year inventory, because the emissions from the acquired unit are considered significant, the company has to recalculate its base year inventories, and it does this by adding the 15 tons of emissions the unit emitted in year 1 to its base year. And note that the company could also recalculate the inventory for the second year, but doing so is entirely optional. The only requirement in the corporate standard is to recalculate the base year inventory. Companies don't have to recalculate emissions inventories for intervening periods, although they often do. Conversely, this slide will show an example of how recalculations work if a company divested an operating unit. Here, the company is initially comprised of 3 units. Unit C at the top emits 25 tons in the base year and 30 tons in years 2 and 3. In year 3, the company divests this top unit, so it removes Unit C's emissions from its base year and optionally from the intervening inventory for year 2. Okay. And of course, the emissions from that unit also wouldn't be included in the company's inventory for the latest reporting period for year 3. And finally, one more example. Here, a company has acquired a facility that didn't exist in its base year. In year 1, the company emits 50 tons. In year 2, again, the company experiences organic growth that doesn't trigger recalculation of the base year inventory. And in year 3, the company acquires Unit C. And we can see here that Unit C didn't exist in the base year of the reporting company, but it emitted 15 tons in years 2 and 20 tons in year 3. So in this case, then, the company doesn't recalculate its base year inventory, although it could recalculate its inventory for year 2 if it wanted to. Okay, we will have some further questions or examples just to illustrate base year recalculations, and then we'll conclude the lesson and I'll take some further questions. So here we have a company, Company A, which experiences an increase in demand for its products, and it opens then a new factory in year 2 to meet this demand. And the question is, should the base year emissions be recalculated? And the answer is no, because even though there's a significant increase in emissions between year 2 and the base year, we do not recalculate the base year inventory for organic growth. The second example, the demand for a company's products again increases, And reacting to that demand, the company acquires an older company from another company. In this case, should the base year emissions be recalculated? And the answer is yes, because here we have a structural change which triggers recalculation of the base year inventory. And we do this recalculation assuming that the structural change exceeded whatever significance threshold the company has set. Let's take another example. Here a company has set a 5% significance threshold for errors. And we see its original estimates. Later on, though, the company discovered an error and restated its base year emissions, or recalculated the emissions, rather. And the question is, does the company need to recalculate its base year inventory? And in this case, the answer is yes, because clearly the errors met the 5% significance threshold, triggering recalculation of the inventory. Okay. I have one more slide of different cases. We'll look at these, and then we'll take a break for questions. So in the first situation, a company acquires another company. Does this trigger recalculation? And the answer is yes, provided that the significance threshold was exceeded and that the acquired company existed in the base year of the reporting company. In the second situation, the production of steam is outsourced. Let you think about that for a second. And the answer is no. Here, recalculations are not needed because the emissions from outsourced steam production are scope 2, and so will still have to be reported within the inventory. A company has to report all of its scope 1 and scope 2 emissions, and so in this case, there's no need to recalculate the base year inventory. Third case, the company produces more and emissions increase as a result. As we've seen in a number of cases already, the answer is no. This is a form of organic change and recalculation should not be done. And finally, the company installs a continuous emissions monitoring system. More about those in a few minutes. But the company installs this system and collects more accurate data as a result. Will this trigger recalculation of the base year inventory? And the answer is maybe. It will trigger recalculation of the base year inventory, provided that the more accurate data show changes that met the significance threshold. Otherwise, recalculation would not be required. Okay. So in summary, the base year is the year in history against which an organization's emissions are tracked over time. Companies need to define a recalculation policy, which essentially means that they need to define a significance threshold to determine when recalculations are needed. The corporate standard doesn't specify a threshold, although 5% or even 5% or 2% is a typical benchmark. Recalculations are needed for changes in structural changes, changes in organizational structure, changes in calculation methodology, and the discovery of significant errors. At the same time, it's important to be mindful of things that do not trigger recalculation of the base year inventory, and those are organic growth or decline, changes involving facilities that didn't exist in the base year, because otherwise recalculation wouldn't be possible. And also insourcing or outsourcing of activities that were previously accounted for under a different scope. Okay. It's important to know then the factors that do and do not trigger recalculation. In terms of further reading on this topic, the first reference should really be Chapter 5 of the Corporate Standard, dealing with tracking emissions over time. Chapter 11 also provides some guidance on choosing a base year, especially if the company wishes to set a target. And Appendix E, which is online, provides some further guidance on recalculating the base year inventory to account for changes in organizational structure. So those should be your primary references if you have any questions on this topic outside of this training program. Okay, I see we have a number of questions. Let me take those now, and then we'll break and come back to do the exercise for lesson 5. Well, Lizzie asks, what if a company discovers a recalculation error but has not yet previously set a significance threshold? Companies must set a significance threshold under the corporate standard. That's one of the first things they should do. First step is to develop an inventory, but then companies should really define a policy for when the base year inventory should be recalculated. And yes, Valeria asks whether the boundary should be checked every year to ensure that companies continue to be within the 5% threshold. The answer is yes, that's right. That's true for large or small companies. Companies should continuously check to make sure that changes do not meet the significance threshold if they're not recalculating the inventory. Damien asks, couldn't it be complicated to find data to recalculate a base year inventory when acquiring a company? And the answer is it can be complicated. There are a number of possible solutions here. If activity data can't be found, one possible solution is just to use default or industry average emissions data. So for example, if I were purchasing a cement company, I might want to use activity data from that company, that is information on the volume of cement it produced, then multiply that information with industry default emission factors to obtain some estimate of the emissions. And I would then include that information in the base year inventory. I think that's one approach that's often used. I think a better approach would be to calculate emissions data for that acquired unit, okay? And those emissions data would be included in the inventory of the reporting company for the current reporting period. But it's okay to also use those calculated emissions data for the base year inventory. So just one would assume then that the emissions of the acquired unit were the same in both the current reporting period and the base year, okay? And that's fine. I think that's perhaps a more conservative approach in dealing with that situation. Logan asks whether, or he states that, I understand that opening a new factory would not cause recalculation. I assume this is the same for opening a new office. And yes, you're correct. Organic growth relates to openings of new factories, offices, or any units. Okay, it doesn't matter whether it's a factory or office or something else, it's still a form of organic growth and would not trigger recalculation of the base year inventory. Jeff asks, if a company acquires a new unit that didn't exist in its base year, can it choose a new base year that includes when that new unit was built? And the answer is yes. That's perfectly fine. A company can always refresh or change the year of its base year inventory. There's certainly no problem with that. Jennifer asks whether the 5% threshold is standard amongst most voluntary greenhouse gas reporting programs, and the answer is yes, it is fairly standard. Mandy asks, if a company has been reporting scope 1 and 2 for several years and then begins reporting scope 3, should the first scope 3 year automatically become the new base year? So that is, should a company advance its base year to the present reporting period if it starts reporting scope 3 emissions? From my perspective, yes, I think that's ideal. For many companies, in fact, most companies, the bulk of emissions occur from scope 3 sources. So it would be ideal to move the base year to the most recent reporting period, particularly if that scope 3 inventory was comprehensive and dealt with the most important scope 3 categories. Valeria, to answer your question, Valeria asks whether the threshold applies to only scope 1 and 2 or also for scope 3. And the answer is it applies to the total emissions reported by a company. So if a company happens to report scope 3 emissions, then that threshold would apply to all scopes, scopes 1, 2, and 3. So you really just want to assess the effects of changes relative to the total amount of emissions reported by the company, whether they occurred scope 1, 2, or 3. Priscilla asks whether recalculation is needed when a company purchases a new company that didn't exist in its base year. Here the answer is no, and in fact recalculation isn't possible because no data, the company simply didn't exist in the base year of the reporting company, so it wouldn't make sense to try to conduct the recalculation. So again, recalculation is not needed when an acquired unit did not exist in the base year of the reporting company. Okay. I see a number of other questions here. What I propose is that we take a break. We're scheduled to take a break at, I believe, 11:45 local time. Actually, let me just continue, since we do have time then, let me answer the remaining questions and then we'll take a break. Cecilia asks a great question, can recalculation be triggered by changes to biogenic emissions? And technically the answer is no, because biogenic emissions are reported outside of the scopes. We're not concerned with biogenic emissions because recalculations really just depend on the extent of change in emissions under the scopes, okay? But having said that, companies often do set targets around their biogenic emissions, and indeed, the Science-Based Target Initiative requires companies to set targets that cover biogenic emissions. So if there is a substantial change in biogenic emissions, then that might be one reason for recalculating the base year inventory, provided that the change in biogenic emissions stemmed from an organizational structure change or some of the other factors I mentioned previously. Sarah asks whether there are any advantages or disadvantages to selecting a new base year. One advantage is credibility. I think having a recent base year makes a target look more robust and credible to external audiences. One disadvantage, though, is that if a company has an existing target and then revises its base year inventory, then it may find that its progress, its attainment of that target may have changed. So it may previously have reported that it was, say, 50% towards attaining a target, but then after revising its base year and moving that base year forward, it may find that it's actually its progress towards the target has changed. So that can be an awkward thing to communicate publicly and is worth bearing in mind. And Alina, there's a specific question, but I'll answer it to the entire group. There are trainings on the corporate standard available in Brazil through the Brazil GHG Protocol program, which is a voluntary corporate level reporting program. So if you just Google Brazil GHG Protocol program, you'll find links there to the appropriate contacts. Okay, I think I've answered most of the questions. I'll respond to a couple of these by text, but for now, let's take that 10-minute break. I'll set the egg timer. Okay, so we'll regroup in 10 minutes. Thank you, everyone. Okay, so welcome back, everyone. Let's turn to the exercise for session 5. And there are a total of 7 questions in this exercise, but individually they should not take long. So what I want to do is divide the exercise in half and give you 5 minutes to answer the first 3 questions. I'll come back then with the answers, and we'll repeat that process for the next 4 questions. So for now, please take 5 or so minutes to look at questions 1 through 3. That's questions 1, 2, and 3. And then I'll come back within 5 minutes with my answers. Okay, thank you all. Okay, let's look at the answers to question 1. In the first case, Enviro Corp merges with neighboring second-gen renewable energy company. And here is recalculation needed. Yes, and the answer is because mergers and acquisitions trigger base year recalculations, provided the change is significant and met the significance threshold, and that in this case, the renewable energy company existed in the base year of EnviroCorp. The second case, heat is no longer produced on site and is outsourced to a third party. This is again a case where the emissions are simply being shunted from scope 1 to scope 2, and because emissions under those scopes have to be reported within an inventory, then there's no need to recalculate the base year inventory. The third case, 7 facilities are sold by one company to another, and here, yes, a recalculation is required provided that the significance threshold was met. The fourth case, a company installs continuous emissions monitoring systems at its facilities. And here, the answer is recalculations may be needed and would be required if the new monitoring systems resulted in more accurate data that met the 5% threshold. Next, EnviroCorp changes its production mix of electricity and heat. And in this case, no, recalculation is not needed because then, again, all we're doing is shunting emissions to and from scopes 1 and 2. So there's no need for recalculation in this case. And finally, the company acquired a brand new production facility. Here, recalculation is not needed because the production facility did not exist in the base year of the reporting company. Okay. And as Quinton pointed out, that last point also applies to the first case here, when EnviroCorp merged with a neighboring company. While we said that recalculations would be needed if the threshold was met, recalculations wouldn't be needed if the acquired company didn't exist in the base year of the reporting company. Okay, so thank you for pointing that out. Let's move on to question 2. And here the company could select 2006 or 2008 as its base year. And again, the company could select 2008 if it wanted to track scope 3 reductions moving forward. Okay. So feasibly, the company could select 2006 as its base year because it's the earliest year for which verifiable data are available. But if the company wanted to track scope 3 emissions in the future, then it could select 2008. And then if we just turn to question 3, the base year emissions for company G would be recalculated because in this case, we recalculate for acquisitions and the structural change met the significance threshold. And in this case, the recalculated base year emissions amount to 13,000 tons. Okay. The remaining questions shouldn't take long at all. I'll give you a minute or two to tackle them. So that's questions 4, 5, 6, and 7. If you could please answer those now, and then I'll come back in a couple of minutes with my answers. Thank you, everyone. Okay, so let's get back to the exercise and look at question 4. For question 4, a company outsourced tire manufacturing to some other company. What are the implications of that? Well, the reporting company would recalculate its base year inventory because the change in emissions was significant. It was on the order of 20%, so far above the standard threshold of 5%. There's one nuance here, though. If the reporting company instead decided to report the Scope 3 emissions from the outsourced activity, then there would be no need to recalculate the base year inventory because it's still reporting the emissions from that activity. Okay. And in this situation, what are J's recalculated base year emissions? The answer is 20,000 because it sold the tire production operations of its business and only retained the body parts one. And company K in this case would not have to recalculate its base year inventory at all because here it's just undergone a form of organic growth. Question 5 involved the paper company, and to meet an increased demand for its products, company M opened up a new paper plant, and here recalculation is not needed because we don't recalculate for organic growth. In question 6, a company uncovered calculation errors that collectively were less than the 5% of total emissions, meaning that recalculation was not triggered in this case. But for question 7, the threshold was handily exceeded. The calculation errors were greater than 5% of total emissions, and recalculation is then performed. Okay, so that concludes lesson 5 on tracking emissions over time. We're pretty much on track, so let's start lesson 6 on calculating emissions. Okay. So far, then, we've covered the main accounting steps in developing an inventory. We turn to the topic of quantifying emissions. And in this lesson, we'll cover how to identify the relevant emission sources to include in an inventory and how to calculate those emissions. We'll learn where to find helpful calculation tools, and we'll be summarizing some useful internet resources that offer tools or other resources for calculating emissions. And finally, we'll also look at how companies can combine emissions data from individual facilities and operations into a single consolidated corporate level inventory. This slide shows the 5 basic steps in calculating emissions: identifying emission sources, selecting a calculation approach, collecting data and choosing emission factors, then applying those factors and tools and rolling up the emissions data to the corporate level to come up with a single inventory. And in this lesson, we'll walk through each of these steps in turn, looking first at identifying emissions sources. Now, we touched on these sources on day one. There are four major types of emission sources, which differ in the types of greenhouse gases emitted, as well as the accuracy with which those emissions can be calculated. Stationary combustion sources, combust fuel and stationary sources, such as boilers and heaters. Mobile combustion sources are simply transportation vehicles or mobile machinery. Process sources are physical or chemical processes that emit greenhouse gases, including such things as cement calcination, aluminum smelting, etc. And fugitive sources are unintentional releases of greenhouse gases from, for example, natural gas transmission and distribution systems, air conditioning equipment, etc. So if you represent a specific industrial sector, you might find Appendix D in the corporate standard useful, and that appendix summarizes the types of emission sources associated with major industrial sources, major industrial sectors, and that appendix would provide some information then on the industry-specific process sources associated with those sectors. So Appendix D provides that information. However, for the purpose of this training program, we're going to focus on cross-sector sources, namely stationary combustion, mobile combustion, the fugitive emissions of refrigeration or refrigerants from refrigeration and air conditioning equipment, and electricity consumption. As a first step in calculating emissions, you should try to identify the direct emission sources in each of the four source categories. Process emissions are usually only relevant to certain industry sectors, as I mentioned, such as oil and gas or aluminum sectors. Manufacturing companies that generate process emissions and that own or control a power production facility, they will likely have direct emissions from all the main source categories. And on the other hand, office-based organizations may not have any direct emissions whatsoever, except in cases where they own a vehicle or perhaps a boiler or refrigeration and air conditioning equipment. Okay, but many office organizations do not have significant Scope 1 emissions at all. The bulk of their emissions would come from Scope 2 sources. So once Scope 1 sources have been identified, the next step for a company is to identify indirect emission sources from the consumption of purchased electricity, heat, or steam. And almost all businesses generate indirect emissions due to electricity purchases. And that's one reason why Scope 2 emissions have to be reported under the corporate standard. And finally, companies can identify other indirect or Scope 3 emissions. And as we saw earlier, this step is optional under the corporate standard and involves identifying other indirect emissions from a company's upstream and downstream activities, including, say, those activities associated with outsourced or contract manufacturing, leases, franchises, etc. Once the relevant emission sources to include in an inventory have been identified, the next step is to select a calculation approach for each of those sources. Now, there are three broad types of calculation approaches, and we'll go through them now. One is direct measurement, which involves monitoring actual levels of greenhouse gas concentration and flow rates from a stack, from some kind of emitting stack. A common example of a direct measurement approach is the use of SEMS, or continuous emissions monitoring systems. These would contain all of the equipment required to directly measure a gas's concentration or emissions rate. SEMS equipment can capture real-time data for carbon dioxide from any stationary combustion unit that emits from a stack. And it can also be used to calculate the nitrous oxide emissions from certain industrial processes, including adipic acid production or nitric acid production. It's worth noting here that with the correct operating procedures, SEMS data can be extremely accurate. But without the proper installation and ongoing performance testing and verification of that equipment, then that accuracy can quickly disappear. But the broader point is that directly measuring emissions is not common and is generally limited to stationary combustion sources. Instead, emissions are much more often derived from a calculation-based approach using either what's called a stoichiometric calculation approach, or more commonly, emission factors. Okay, so just to explain what a stoichiometric approach is, a stoichiometric approach really just follows the mass of a specific element as it enters or leaves a source. And because chemical elements can't be destroyed or created, this approach can be used when an element's input and output streams are known. Okay, so one just subtracts the carbon in the output stream from the carbon in the input stream to obtain the residual, which is the mass of carbon that was emitted from that process. As with SEMS equipment, there are certain disadvantages to using stoichiometric methods. It's worth noting that small errors in data or parameters such as, say, pressure, temperature, or steam or stream concentration, all of those things can create quite large errors in the final estimates. And so what we recommend is that if a mass balance approach is used, that it be applied over a sufficiently long period of time to ensure that any errors or uncertainties are averaged out. One example of a stoichiometric approach, which I think I mentioned on day one, is the GHG protocol cement tool, and a stoichiometric approach is used to calculate the CO2 emissions from cement calcination. So that's the stoichiometric approach in a nutshell. The third calculation approach involves the use of emission factors, and here emissions are calculated by multiplying activity data by an appropriate emission factor. Okay, and because the use of emission factors is by far the most common approach to calculating emissions, we'll concentrate on emission factors for the remainder of this lesson. Okay, so the basic equation in applying emission factors is as follows. Activity data times the emission factor gives the emissions of a particular greenhouse gas in tons of that gas. And that amount is then multiplied by the global warming potential to give the final result in units of carbon dioxide equivalent. What I'll do now is just spend a few slides on each of the basic components of this equation, on the activity data, the emission factors, and GWP, or global warming potential values. Activity data are simply data on activity that results in emissions. Examples of activity data are varied, and common examples include electricity use, measured in kilowatt hours, say, distance traveled, measured in kilometers or miles, and gasoline use, measured in gallons, for example. Activity data can be found in many different types of records, but generally companies should consult their fuel purchase records for activity data on stationary and mobile combustion, metered electricity bills for Scope 2 emissions, and a wide range of other records for other types of Scope 3 sources. Scope 3 sources are, as we've seen, quite varied, and a wide variety of activity data records would be needed to calculate those emissions. In contrast, calculating or collecting and calculating Scope 1 and 2 emissions is much simpler. Obviously, certain industrial sectors will have their own unique types of operations and sources, and companies in those sectors are recommended to consult sector-specific guidance to determine how they could collect the activity data for those operations. Such sector-specific guidance is available from a range of sources, including the GHG Protocol website, industry associations, and government agencies. And we'll be talking a bit more later on about the GHG Protocol sector-specific guidance. So you'll have a chance to understand at least some of the range of resources that are out there for finding activity data and calculating emissions. We turn to emission factors, the second component of our equation. Emission factors basically convert activity data to emission values. They're published by various entities, including government agencies and intergovernmental organizations. And I'll turn to that point on the next slide. Something to note, it may seem obvious, but it's quite critical, is that emission factors are presented in specific units. For example, kilograms of carbon dioxide per air kilometer traveled, or kilograms of CO2 per liter of petrol. And so given that, it's clearly important to make sure then that the units match those of the activity data. Another point is that we do recommend that companies use the most recent available emission factors while maintaining consistency. That's an important point. We find that Scope 2 emissions, for example, are updated with a lag period of every 2 to 3 years. So the emission factors in the United States for 2018 electricity consumption, emission factors for 2018 may only be published 3 years from now in 2021. So it's important to incorporate those revised emission factors once they have been released. And that may necessitate a revision to the base year inventory. If we look at emission sources more closely, or emission factor sources more closely, emission factors are available from a wide range of sources and can be developed for a wide range of spatial scales. The IPCC is the Intergovernmental Panel on Climate Change, and it's charged with developing the methods that countries use to develop and report national level greenhouse gas inventories. The IPCC emission factors are generally global defaults. That is, they're intended to be used internationally, regardless of country. The IPCC emission factors are based on literature from various sources and countries and on assumptions about commonly used types of fuels and technologies. Generally, the IPCC defaults are based on studies that are biased to temperate regions, so they may not always be the most accurate choice for corporate inventory. Having said that, though, it's generally fine to use these IPCC default emission factors for developing corporate inventories. That's fine. The GHG protocol uses the IPCC emission factors in its tools alongside some country-specific emission factors, including those from government agencies in the UK and United States. I think the UK and US are particularly good in sharing databases of emission factors. Those databases tend to be quite comprehensive. So we've discussed default emission factors to some extent, but emission factors can be developed on an even finer scale. Emission factors can be developed using data from periodic sample testing, control equipment specifications, product data sheets, or emissions models, for example. So one way to improve the accuracy of emission factors for all kinds of gases and sources is to develop site-specific factors. And that will then require testing at the source in a representative variety of operating conditions, and then using the test data to develop an emission factor for that source. Although not all sources can use that process, companies with large stationary combustion sources or other large sources that represent a significant chunk of their overall inventory, those companies may find it useful to develop site-specific emission factors because doing so can greatly improve the accuracy of their inventory. The advantage of emission factors is that they are much easier to use than direct monitoring or stoichiometric approaches, but there are certain potential disadvantages to be mindful of in using emission factors. In general, emission factors tend to more accurately estimate CO2 emissions and are less accurate in estimating methane and nitrous oxide emissions. And that's because the emissions of methane and nitrous oxide are heavily dependent on the fuels and technologies employed. So they're heavily dependent on the reporting companies' operating conditions and equipment. It's also worth pointing out that emission factors are also generally more accurate for stationary and mobile combustion sources and less accurate for process and fugitive sources. So companies, just to recap, companies should be mindful of potential inaccuracies in the emission factors used, and that's especially the case for non-CO2 emissions and for process and fugitive emission sources. There are some sector-specific requirements surrounding the use of Scope 2 emission factors, and these requirements were introduced in the new Scope 2 guidance. To recap and to answer a question that came through earlier, there are two approaches for recalculating and reporting Scope 2 emissions under the new guidance. One is the market-based approach, which companies used to reflect the emissions profiles of these differentiated electricity products that they have specifically contracted for. And to calculate market-based emissions totals, you would use emission factors specific to those products. The other approach is the location-based method, wherein Scope 2 emissions are calculated using grid average emission factors. If we look at the location-based method first, the location-based method involves the use of grid average emission factors, and these represent all electricity production occurring within a defined geographical region. And the goal for the location-based approach is that grid average emission factors should reflect the mix of electricity actually used in the region where consumption is occurring. Okay. There is an accuracy hierarchy for grid average emission factors. Regional or subnational emission factors tend to be more accurate than national emission factors. Multinational or regional emission factors do exist, including for the Nordic region as a whole. And those are okay. Those are okay if they take into account energy transfers across national borders. But the broader point here is that regional or subnational emission factors are preferred over national production emission factors. Turning to the market-based method next, the premise of this method is really to link specific units of electricity generation to consumers through what we've termed a contractual instrument or a differentiated electricity product. So we're not as concerned with geographical boundaries as much here. Instead, we're looking at the emissions profile of individual generation units or individual companies that supply power. This slide shows the different types of emission factors possible for the market-based approach. And these are listed in order from most precise to least precise. But I think it's important to point out that this list doesn't reflect a preference about procurement methods. So it's not indicating that companies should preferentially source power from a PPA instead of sourcing electricity certificates or RECs. Okay, so this is basically a hierarchy intended to convey information about the relative likelihood, or sorry, the relative accuracy of different emission factors. These emission factors include electricity attribute certificates or equivalent instruments, so RECs or guarantees of origin, contracts for electricity such as PPAs, and supplier utility emission rates. When a company is using the market-based approach, it should ideally use one of these three emission rates or options. But if these three options are not available, then a company can default to residual mixes or to the grid average emission factor to calculate emissions under the market-based approach. Okay, so the third component of the calculation equation concerns GWPs, or global warming potentials. GWPs basically measure how much a greenhouse gas contributes to global warming relative to CO2, and they're used to convert tons of a greenhouse gas to tons of carbon dioxide equivalent. That then allows us to express all emissions of different gases on a common currency. The higher the GWP value, the greater the warming capacity of that gas. So carbon dioxide has a GWP value of 1, and a gas that has a GWP value of, say, 10,000 has a much higher warming capacity than carbon dioxide per unit ton gas. GWP values are published in so-called IPCC assessment reports, and those reports are updated on a periodic basis. The values shown on this slide come from the second assessment report from the IPCC, which was published in 2006. And we'll be using these factors, I believe, later on in today's exercise. We recommend that companies use either these values from the second assessment report or the values from the most recent assessment report, which is the fifth assessment report published in 2015. Companies can use the values from the older report, the second assessment report, because those values are still used in national inventories, and companies may be required to use those GWP values for reporting under mandatory government schemes. I would say, though, that if a company is just starting out to develop its inventory, then we'd recommend the use of the GWP values from the fifth assessment report, because those would reflect then the most recent scientific understanding of the impacts of different greenhouse gases. Elena has shared with you a PDF that lists the GWP values from both the second assessment report and the fifth assessment report. So hopefully that'll be useful to you as a resource should you go on to construct an inventory. Okay, so now that we've covered the basic components of the emission factor approach, let's illustrate that approach with a simple example. And we'll have more involving examples later on, but for now, let's just consider how a company would quantify the emissions of CO2 from transportation, from vehicle travel. And the first step for the company is to identify and obtain the most relevant activity data. And here the company consults its fuel purchase records and determines that it consumed 100 litres of gasoline. The second step is to obtain an appropriate emission factor. Here the company consults the emission factors from, say, the GHG Protocol website and determines that the appropriate emission factor is as follows, as shown on this slide. The next step is to calculate the emissions in units of carbon dioxide. So we multiply the activity data by the emission factor, and 0.23 tons of carbon dioxide were emitted. Next, the company should determine the appropriate GWP value for this gas. And because we're looking at carbon dioxide, the GWP value is 1, and emissions in units of carbon dioxide equivalent are still 0.23 tons. Okay. Let's take another example looking at how one would calculate the methane emissions from the use of purchased electricity, this time using the location-based approach. So we consult the electricity bill and determine that the company consumed 1,000 gigawatt hours of electricity. We multiply that by an emission factor for methane. 39 tons of methane were released. We then multiply that by the appropriate emission factor, by the appropriate global warming potential value, and find that the company emitted 819 tons of carbon dioxide equivalent. And again, the GWP value here for methane is 21. That comes from the second assessment report, showing that methane is a much more potent greenhouse gas than carbon dioxide. Let's take another example, this time calculating CO2 emissions from the use of purchased electricity, this time under the market-based approach. So again, we consult the electricity bill, and this time the company identifies its contractual instruments. In this case, say that the company has purchased enough RECs to completely match its consumption of grid electricity. Though the emission factors attached to those RECs are 0, okay, so 0 tons of methane. And so then the final emissions total is 0 tons carbon dioxide equivalent. Previously, I mentioned the GHG protocol set of calculation tools. These are freely available from the GHG protocol website. We don't require companies to use them. We simply provide them to help companies get acquainted with the process of calculating emissions. The tools are relatively simple to use and have been developed in collaboration with industry experts, so they would offer best practice for many industries and sources. Okay. There are two main categories of calculation tools offered by the GHG protocol. We have cross-sector tools that can be applied to different sectors, that can be applied across sectors, and we have cross-sector tools for stationary combustion, mobile combustion, HFC use in refrigeration and air conditioning equipment, and electricity use. And we'll be looking at those tools later on tomorrow in the final inventory exercise. Then we also offer a number of sector-specific tools designed to calculate emissions in specific sectors, such as aluminum, iron, steel, cement, pulp and paper, etc. And just quickly to note, some of those tools have been customized to specific countries, such as India, Mexico, and China. So we'll have a lot of time to look at the cross-sector tools tomorrow, so enough about them for now. Let's turn to the final step in calculating emissions, which is rolling up emissions data to the corporate level. Basically, there are two approaches for gathering emissions data from a corporation's facilities. One is called the centralized approach, and the other is the decentralized approach. In the centralized approach, individual facilities report activity or fuel use data to the corporate level, where the emissions are then calculated. And in turn, in the decentralized approach, individual facilities collect activity data. They directly calculate the emissions using approved methods, and then they report those data to the corporate level. So the difference between these two approaches is in where the emissions calculations occur and in what kind of quality control procedures are put in place at each level of the company. Under either approach, staff at the corporate and lower levels of consolidation should take care to identify and exclude any Scope 2 or Scope 3 emissions that are also accounted for as Scope 1 emissions by other facilities within the inventory boundary. Okay, so that's necessary to ensure that double counting of those emissions is avoided. There are a range of considerations that go into choosing one approach over the other, and the corporate standard doesn't require companies to use a specific approach. That wouldn't make sense, but the centralized approach might be the preferred option if the staff at the corporate or division level can calculate emissions data in a straightforward manner based on the activity or fuel use data. Again, the centralized approach might also be preferred if emissions calculations are standard across a number of facilities. On the other hand, the decentralized approach is often favored if emissions calculations require quite detailed knowledge of the kind of equipment being used at facilities, or if emissions calculation methods vary across facilities, or if process emissions make up an important share of total GHG emissions. And that's because process emissions can require quite elaborate or sophisticated methods for calculating the emissions and a lot of on-site knowledge. There are a number of other reasons why a decentralized approach might be preferred. One is if resources are available to train facility staff to conduct the calculations and to audit them. And another reason oftentimes is if local regulations require reporting of emissions at the facility level. And if that's the case, then companies will often opt for a decentralized approach. But to summarize, the choice of collection approach will really depend on the needs and characteristics of the reporting company. So let me summarize the materials so far. We've covered a number of topics in this lesson, ranging from identifying the emission sources to choosing emission factors and then rolling up the data to the corporate level. For further information on these topics, you should consult Chapter 6 in the Corporate Standard, which deals with identifying and calculating greenhouse gas emissions. And another primary resource should be the Scope 2 guidance, especially for those market-based emission factors. I went through the presentation there in one go because I'm mindful of time and I want to make sure that we have sufficient time to complete lesson 6 today before we launch into the other lessons tomorrow. We do have time though for some Q&A, so let me answer questions in the chat box. Valeria asks whether these two approaches can be mixed, whether a company can use a decentralized approach for example, Scope 1 sources and a centralized approach for Scope 3 sources. And the answer is yes, that's perfectly fine, just as long as a company is accounting for its complete Scope 1 and 2 emissions, that's perfectly fine. To answer Jorge's question, he asked why the emissions were zero under the market-based method. Let me go back to that example. The emissions were 1 here because the company used an emission factor specific to a renewable energy certificate. And the emission factor we assume for this certificate was 0. So there are 0 emissions attached to the generation of renewable energy. And so the emissions would be 0 for the market-based approach. And that's assuming that the company purchased sufficient RECs to match its entire consumption of grid electricity. If it didn't, then the Scope 2 emissions under the market-based method would be positive, they'd be non-zero. To answer Emma's question, yes, you can use a combination of different calculation methods. One could use emission factors for certain sources and a stoichiometric approach for other sources. That's perfectly valid and is done by companies. One question reads, will the tools include an estimation for retail or office spaces where utility data visibility isn't always readily available? So that's a great question, and I don't believe the tools do, but there is an exercise tomorrow where we will be covering that issue. And in general, a company would or could resort to default emission factors. So it could look up emission factors which describe the emissions per unit of average office space in the United States, for example, and then use those default emission factors to calculate the emissions. Another question is, for activity data with multiple types of greenhouse gases, do we add together the carbon dioxide equivalent? So this question relates to reporting requirements in the corporate standard. We'll cover those in detail tomorrow, but for the time being, companies have to report the emissions of each gas separately, and then emissions of each gas in units of carbon dioxide equivalent. Okay, and then once they've done that, they can sum up the emissions across gases in units of carbon dioxide equivalent. But we'll look at that more closely tomorrow. Jennifer asks, is the use of revised GWP values one reason for recalculating the base year inventory? And yes, it can be. If a company adopts new GWP values and finds that the inventory has changed by more than 5%, say, then that would trigger a recalculation of the base year inventory. Someone asks that, or whether based on the hierarchy of emission factors we showed earlier, whether it's possible to assume a range of error for the estimates. And the answer is no, not really. The emission factors were calculated using different approaches, and that they're very specific to either certain grid systems or to certain types of contractual instruments. So it wouldn't make sense then to try to develop an estimate of error for scope 2 emissions by calculating emissions using multiple emission factors. That wouldn't make sense in this case. Antonio asks whether if natural gas is burnt for heating, whether that natural gas would fall under scope 1 or scope 2. If the natural gas is being consumed by sources that are owned or controlled by the reporting company, then the emissions would fall under scope 1. Otherwise, it's probably a scope 3 source. Okay, just a couple more questions and then we'll start the exercise. Jorge asks where renewable energy certificates go in the end. Well, renewable energy certificates should be tracked through some kind of tracking system. So they're tracked at the point of energy generation and then tracked through, the purchases of those RECs would be tracked, as would the claiming of a REC. Okay, and so that means then that a user or a purchaser of a REC has some confidence that the emissions benefits of that REC has not been double counted. And ultimately, that rec goes to the entity that claims the emissions reduction benefit in its inventory, or the entity that last purchased the rec. Valeria asks whether it's reasonable to use country-specific emission factors for fuels and materials in Scope 3, as is done for electricity in Scope 2. Yes, that's very reasonable. Companies would use national level emission factors for stationary combustion and fuels, for example. Oftentimes, Scope 3 emission factors are not available at the national level. They're not available at such a granular level, but it's perfectly fine to use them when they are available. Okay, so a few more questions here, but I'll answer them by mail while others are, while we're attacking the exercise for this lesson. So let's load the exercise for lesson 6. That's the answer sheet, which I don't want to share with you just yet. Here is the question sheet. I'll give you a few seconds to load it yourself. It's going to be a more involving exercise than the one we just did for lesson 5 on tracking emissions. So it'll take a bit longer to complete. Let's look at question 1, which concerns calculating the direct emissions from stationary combustion, so a Scope 1 source. Here we have a company, F&M, a manufacturing facility with 2 10-megawatt generating units. One combusts natural gas and the other coal. The company also has a commercial office building on site that's heated with diesel. We're provided with some information on consumption over the year. And you're asked to calculate the company's total emissions of carbon dioxide from stationary combustion. And to do that, you can use the following emission factors. You should, in fact, use these specific emission factors. We're only looking at carbon dioxide here, but there'll be an option to look at the emissions of methane and nitrous oxide that will be produced in fuel consumption in the next question. So this should be a relatively straightforward calculation, given that it's only for carbon dioxide. Let's take a few minutes or so to answer question 1. I'll come back to review the answers, explain the results, and then we'll move on to the next question, the exercise. Okay. So thanks everyone for your attention. Please keep on firing these questions through, and I'll come back in a couple of minutes. Thanks all. Okay, let's take a look at the answers to question 1. The first step was to calculate annual diesel consumption, taking into account the volume of stock that existed at the beginning and the end of the year, and then inferring the amount of diesel that was consumed. That amount is 35,900 litres. And the second step was to calculate the CO2 emission factors using the fuel-specific emission factors. So the CO2 emissions from natural gas consumption amounted to 38,282 tonnes. The emissions from coal use amounted to approximately 91,000 tonnes. And the emissions from diesel use amounted to 95 tonnes. Okay. So summing over those sources, total CO2 emissions are 129,365 tonnes. Okay. And if you didn't quite catch some of the calculations, don't worry, we will be sending out these detailed answer sheets at the end of today. Let's turn to the second question. Here, GoFast Vehicle Rental is an independent vehicle renting company with a fleet of 200 passenger cars from a specific model year, 25 light-duty trucks, again with a specific model year, and 2 heavy-duty diesel-powered trucks. And this passage then gives more information on the amount of fuel used and the distance traveled by these classes of vehicles. I'll let you read that passage in your own time, but you're asked to calculate the emissions of carbon dioxide, methane, and nitrous oxide from mobile combustion. So this is a more complicated exercise as we're now dealing with GHGs other than carbon dioxide and must now take into account the global warming potential values. Here are the emission factors to use for these calculations, and you'll note perhaps that the CO2 emission factors are expressed on a per litre basis, while the methane and nitrous oxide emission factors are expressed on a per kilometre travelled basis. Why is this? The answer is that the CO2 emissions from fuel combustion are mostly determined by the amount of carbon in the fuel, and therefore the type of fuel used. So petrol versus diesel, for example. On the other hand, the emissions of methane and nitrous oxide are much more determined by the combustion technologies and the pollution control technologies employed in the vehicles. And these emissions then are much more a function of distance rather than fuel used. For this exercise, we will be using the GWP values from the second assessment report. So I'll make sure they're on my screen. Okay, this is a more involving question. It's certainly the most involving question we'll do over the course of the training. So I'll give you about 10 minutes or so to come up with an answer, and then I'll provide my answers to the group and explain my approach. Okay, let's take a look at the answers to question 2. I won't go through the derivation in detail, but you will have these answer sheets to refer to by the end of today. The first step is, again, to calculate the total amounts of fuel use by taking into account changes in fuel stocks from bulk purchases. So total gasoline use was 935,000 litres and diesel use was 18,000 litres. We can do the CO2 emissions first, as they're easier compared to methane and nitrous oxide emissions. Total CO2 emissions across gasoline and diesel use amounted to 2,198 tonnes carbon dioxide. Now, to calculate the methane and nitrous oxide emissions, it was first necessary to map the appropriate emission factors to the source. And so this table does that. Okay, it assigns the appropriate emission factor to the different classes of vehicles. And then once you've done that, you're then in a position to apply those emission factors. Total nitrous oxide emissions across the 3 vehicle classes amounted to 0.24 tonnes of nitrous oxide, and total methane emissions were 0.29 tonnes of methane. That we haven't finished the calculations yet. We still have to apply the GWP values, and once we do that, we find that total emissions amounted to 2,279 tonnes of carbon dioxide equivalent. Okay, so the vast bulk of the emissions came from carbon dioxide. Okay, so we are kind of running low on time here. So my suggestion is that we tackle the next 2 questions in tandem. These are much simpler calculations. I'll leave them on the screens here. It's question 3 and 4, okay? And they deal with calculating scope 2 emissions from electricity use. So I'll give you a couple of minutes to tackle those questions, and then I'll come back with my answers. Thank you all. Okay, let's look at the answers for these two questions. Hopefully you find them relatively straightforward. For question 3, it's really just a simple matter of multiplying total consumption by the grid average emission factor. The result is 916.32 tons. And we're doing that because we're calculating Scope 2 emissions under the location-based approach. For question 4, it's slightly more involving. We have to calculate the emissions under the market-based method. Total consumption was 800 megawatt hours, and 50% of that consumption is matched by energy from a hydropower. So we assume then that that has zero emissions, has a zero emissions emission factor in our calculations. And the other 50% supply comes from the utility who provides a specific emission factor. So to calculate the emissions, all we need to do is multiply 400 times this emission factor, and the result is 280 tons. Okay. So that's it for now. I don't think we have time to tackle the remaining questions in this exercise sheet. They relate just to the use of the GHG protocol calculations tools, and we will be using those tools in tomorrow's exercise. So we haven't missed anything by not doing those questions. We will be using the tools in depth tomorrow. So that's it from me. I want to thank the group again for being so attentive and engaging throughout the day by sending me lots of questions. Thank you for those. Valeria, I see your request to share questions at the end of the training. We will definitely try to do that and provide some abbreviated answers for the group. I think that would be useful too. I do owe a number of you some answers to a number of your questions, and I will certainly do that today as well. Okay, well, thank you very much all, and I look forward to seeing you all tomorrow. Have a good day. Bye now.